Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Pranay Dureja. He's with Derivatives and Quantitative Investment Strategies Index Research at Nasdaq Global Indexes, as well as Steve Rogers, Chief Executive Officer of Shelton Capital. We're here to discuss how the Nasdaq-100 and its ecosystem have evolved to suit retirement needs. It's great to have the both of you with us. Welcome to Trade Talks. Pranay, let's kick this off with you. What characteristics of the Nasdaq-100 have allowed it to outperform the rest of the U.S. large cap markets?
Thanks so much, Jill. Really what's happened is that over the last 2 decades, what's important to know from a return perspective is that the Nasdaq-100 has approximately tripled cumulative return and on an annual basis has returned about 16%. This happened over the past 2 decades, and this is at a rate about 5% greater than what we've seen in the S&P 500, and we've been able to accomplish these types of returns with volatility about only 3 points higher. So to really understand why we're able to actually accomplish this on such a sustainable scale, it's really important to know what the Nasdaq-100 is to begin with. What we are really is that the Nasdaq-100 is a globally recognized index of 100 of the most innovative large cap companies that are listed on our stock exchange. And so most notably, how this differentiates from other index providers and other notable large cap indexes in the US equity markets is that while most indexes kind of use a committee and kind of vote on bringing in their constituents, instead of choosing constituents at an index level, what we do is we choose the constituents at an exchange level and create a completely transparent, rules-based index methodology in the Nasdaq-100. And so as a result, by choosing at the exchange level and creating this ecosystem of innovation, you're able to create a list of companies that you're able to get concentration towards and actually kind of have that turn into those expanded returns that we've seen over the past 2 decades.
Mm-hmm. So, Steve, what's driving the conversation about the Nasdaq-100 and getting access to it as it relates to retirement planning right now?
Well, as Pranay has alluded to, the Nasdaq-100 index fund has performed exceptionally well. There's a lot of investor demand for it. 45% of the investors in our survey have some exposure to the Nasdaq-100 index fund of some form, at least. And within that, a very few have exposure in tax advantage accounts like their 401k plan. So the dialogue around the Nasdaq-100 index is it appropriate for a 401k plan? And if so, how does that fit into the plan? When you talk about risk, the Nasdaq-100 index, as measured by standard deviation, has risk exposure that's comparable to other large cap growth indices. So we believe that it's absolutely appropriate for investment committees to look at.
Yeah. And Pranay, it's interesting when we think about innovation, it's like what's happening right now, what's driving the capital markets and the economy. But what makes innovation a critical theme for a longer term investment horizon?
Yeah, I think that's a really important way to look at it. Because to be clear, innovation has always been important, but it has become increasingly critical because of the increasing level of importance it holds in deriving value in our markets. A really notable way of looking at this is the physical versus intellectual asset split that we have seen in US large cap equities over time when it comes to deriving market value. So back in the 1970s, physical assets made up over 90% of what drove market value back then. Meanwhile, intellectual assets took about 10%. What's happened today is that ratio has completely flipped around. Now we have 90% of market value being derived through intellectual assets, things such as patents, while physical assets are only taking about 10% of that kind of note. And so because what's deriving value is changing, the way you measure that value creation also has to change. And so the way we view that is, okay, what creates intellectual assets? What creates that value? What creates that value is investing heavily in research and development. And we believe at NASDAQ R&D investment to be the CapEx of the 21st century. Most notably, within the Nasdaq-100, companies in the Nasdaq-100 have consistently outspent companies outside the Nasdaq-100 and the U.S. large cap equity space by over 13 times on a pretty regular basis. And what this allows is for companies to have the investments to file those valuable patents, when you file those valuable patents, you're able to then create value through those patents, both one on your balance sheet and two, able to actually turn those into earnings growth. And what we've seen is that it's led to long run double-digit earnings growth in the Nasdaq 100 that, while the price has gone up at a pretty staggering rate, it has managed to keep valuations range bound with a PE primarily between 20 and 40 over the past 2 decades. And this is what allows the Nasdaq 100 to deliver those market-leading returns. There is a quote by a certain Mark Merricks, a regular of Trade Talks, and he says, innovation drives growth, growth drives fundamentals, and fundamentals drive long-term outperformance, because you could see that virtuous cycle happening through innovation.
Yep, you certainly can. So, Steve, let's see how the sausage is made here, if you will. What should plan committees consider when adding or evaluating any option in a retirement lineup?
Well, I'll take that on in a second. What I'd like to add on to what was just said is that innovative companies tend to list at NASDAQ, which is why an exchange level index like this makes so much sense. But when you get to the more mundane discussion of what investment committees should look at, number one, is there a hole in their plan offering that they need to fill? And typically we find people have basic index funds. They have a selection of actively managed funds that fit within your traditional 9-box spread, for lack of a better word. What's generally missing in 401k plans today is this focus on innovation, and innovation's driving market performance in these markets. And predicting forward volatility or risk is virtually impossible. But I think most investors will agree that over the long haul, which is a 401k participant's perspective, innovation is the single most important factor in long-term returns.
Yeah, well, they certainly are. So as an investment committee, right, when you're deciding what options, what type of investments you want to be able to offer plan participants, how is that done? What's the strategy? What's your methodology behind that?
Yeah, well, if you've got a hole, that's easy. You go in and fill the hole. So we're here to talk about the Nasdaq 100. That's an obvious gap in most plans. When an investment committee looks at individual funds, beyond that, usually you look at risk-adjusted performance over long periods of time. You look at manager tenure. In other words, on the active side of your investment choices, is the same manager that delivered performance 4 or 5 years ago still with the fund? You look at expenses. You want to make sure that the funds are available without transaction fees for your plan participants. So most plans look at some combination of those factors in evaluating choices among a large cap growth active management or small cap growth active management. And then if you get into more sophisticated analysis, moving up the food chain, when you're looking at, let's say, a small cap actively managed fund, you might compare funds that are quantitatively managed versus qualitatively managed and offer one of each of those products, or alternatively, any other investment managers that run these funds have different approaches to purchasing their equities. So you really want to get down into the underlying investment strategy, so you're offering your plan participants different flavors of the same product.
Yeah. Well, let's talk about the participant perspective for a moment here. What retirement trend matters most for staying on track, and what should participants do at the start of the year?
Well, I'll take the second question first and actually say what they shouldn't do. Some advisors will tell people to front load their 401k plans at the beginning of the year so they get the benefit of the year's performance. It's important to know that for plans with matching provisions, that can actually cost investors matches, because as the sausage is made, plan administration usually looks at percentages of payroll as opposed to percentages of annual compensation. And I will skip the administrative reasons for that. But if a high income person were to sweep their annual maximum into their plan in the beginning of January, they would likely forfeit most of the match for the year. They would only get credit for those first 2 payroll periods. So that's what not to do. Make sure you check with the administration firm in how your matches are calculated. But in terms of the long term, what I would say is the biggest mistake retirement plan investors make, participants, is not sticking with a consistent risk exposure over time. So if you look at model portfolios or individual investments, investment, equity investments, large, growth investments, small cap investments tend to perform very well during healthy markets and very poorly when markets are collapsing, or you're in some sort of stress. So sticking to a consistent risk exposure is probably the single most important thing to do, and that avoids buying trailing performance, loading up when markets seem good, and then seeing your investments fall much more rapidly when the markets, typically turn in a temporary fashion, but sometimes painful when they turn against you. You don't want to change your risk exposure at that point.
Yeah. And Pranay, to wrap up here, how has the Nasdaq 100 and its ecosystem evolved to suit retirement needs?
Yeah, absolutely. And I think that's really critical. It's something Nasdaq is going to continue talking about throughout 2026. Steve brought up an important point earlier about Nasdaq being the hub for innovation. It's important to understand that this doesn't happen overnight. Later in, within, I'd say the next month or so, I think it's February 8th, if I remember correctly, Nasdaq will turn 55 years old. And by all means, it took all 55 of those years to build that increasingly resilient hub of innovation. And from that perspective, it's important to note that maybe back in the 1990s, Nasdaq was not looked as the place to go for putting your retirement funds in. In the early days of the Nasdaq 100, markets primarily viewed it as this vehicle of speculation, and the ecosystem really reflected that. Back then, it was mostly derivatives and the QQQ. The inflection point really happened, we believe, during the 2008 financial crisis, during the time when the Nasdaq 100 managed to recover its value subsequently in 3 years by 2011, while it took the rest of the US equity market another 2 years, a total of 5 years for them to recover. And that brings up an important point that has consistently shown up time and time again in the Nasdaq 100. And that's a story of risk versus resiliency. Yes, on paper, you might see that tiny little uptick in volatility within the Nasdaq 100. But what's important to note is not just about that volatility number, but actually how does the index actually bounce back from market drawdowns? Because since the 2008 financial crisis, there have been another 7 drawdowns that have gone past 15%. And the Nasdaq 100 recovered faster than the S&P 500 in 6 of those major 7 market drawdowns that we have seen. And so with this taking place, with the increased resiliency, we really do see that the Nasdaq 100 has evolved into this vehicle that makes lots of sense in a long-term kind of investment horizon. And financial markets have largely taken note. And on our perspective, we've really worked tirelessly to create a wider ecosystem of products to ensure that individuals can have exposure to innovation, regardless of what their risk tolerance is. And that is through traditional methods, such as working with Shelton Capital to create index funds for things such as 401ks. It also means things such as expanding assets to both traditional and options-based ETFs, things such as buffer ETFs that have become particularly powerful for investors who want to actually stay invested in the market while keeping some downside protection. And even lately, we have been making tons of strides in the index annuity space and kind of experiencing record flows across a variety of products. So what we aim to do, and what we will continue to aim to do, is offer every flavor of retirement with the Nasdaq 100.
Yeah, whereas Shelton Capital Management, our ticker is NQQQX, and it's specifically designed for 401k plans. And we've been partners with Nasdaq since the late 1990s. So we've been at this a long time.
Mm-hmm.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.
Yeah.